So we're just waiting a few minutes, everybody, for people to join. We're just waiting a few minutes, everybody, to allow people to join.
Okay, thank you, Joe. Well, welcome to this Five Stone Buildings webinar. This is a talk about nil rate band discretionary trusts. This is a type of trust which I don't think anyone's really had to draft for over a decade, but lots of them still exist and they're likely to be part of private client practice for some time yet. If you have any questions during this talk, there is a question and answer button. What I'll do is I'll take the questions at the end. I should also say that if you don't want me to identify you when answering the question, you can tick a box that will keep the question anonymous. And this talk is being recorded and will be made available on the Five Stone Buildings website later today. And just two other housekeeping matters. First of all, this is strictly for educational purposes. This is not legal advice, so I'm afraid I can't take any responsibility for the contents of this webinar. And the last thing just to say is that I have two small children running around the house. So apologies if any small people try to join in. And if I have to disappear for 30 seconds, I'm just putting on the next episode of Peppa Pig. So with that introduction, let's see, what are we talking about today? Well, five things. How nil rate band discretionary trusts work, how to get rid of them. So if you're dealing with an estate which has got a nil rate band discretionary trust, how do you unwind the nil rate band discretionary trust? I'm then going to look at when you might actually want to use one of these trusts, notwithstanding the fact that it's now possible to transfer an unused nil rate band. There are still certain circumstances when you might actually want to use one of these things. Then I'm going to look at the practice of index linking loans and charges, which is a common feature of these schemes, and the tax consequences of doing that. And finally, I'm going to look at how nil rate band discretionary trusts interact with the residence nil rate band. Okay, so starting with the first topic, so how nil rate band discretionary trusts work. I think most of you will be familiar with these things, but just in case you're not, or you haven't dealt with one for some time, this is just a short reminder. And throughout this talk, I'm going to be talking about the first spouse, that being the first spouse or civil partner to die, and their surviving spouse. Now, before October 2007, if the first spouse died and left their entire estate to the surviving spouse, whilst that transfer would be exempt from inheritance tax on the first spouse's death, the first spouse would effectively lose their nil rate band allowance because it was not possible to transfer your allowance to your surviving spouse or civil partner. So the common practice was for the first spouse on their death to establish a discretionary trust. The discretionary trust would be for the nil rate sum, a sum equivalent to their available nil rate band allowance. And the discretionary beneficiaries would typically be their surviving spouse, their children, grandchildren, and sometimes remoter issue. And then it would just be the residue that would be left to the surviving spouse. And that way, the first spouse would utilize their nil rate band allowance. Now, what the trustees of this discretionary trust could do would be to pay the nil rate sum over to the discretionary beneficiaries. The problem with that is that it would most likely impoverish the surviving spouse, often because to pay that nil rate sum over to the discretionary beneficiaries, the trustees might have to sell the family home, which is not what anybody wanted. So instead of paying the nil rate sum to the discretionary beneficiaries, the trustees would do one of three things. They could enter into a loan scheme. The idea here is that the trustees of the discretionary trust would loan the nil rate sum to the surviving spouse. And that way the trust would be constituted not with the sum itself, but rather a debt from the surviving spouse. The second way of doing it would be through the charge scheme, which is a similar idea, but here the trustees of the discretionary trust, again, instead of paying the nil rate sum over to the discretionary beneficiaries, they would charge assets within the first spouse's estate, usually the first spouse's share of the family home, with a sum equivalent to the nil rate sum. And they would then assent that property to the surviving spouse. So the surviving spouse would get the family home, they would get the sort of entire legal title to the family home, but it would be burdened with a debt through the charge scheme. And that would be what would constitute the trust. So the trust would be of the charge rather than a sum of money. And the third way of doing it, perhaps the simplest way, would be that the trustees, again, instead of paying the nil rate sum over to the discretionary beneficiaries, they would actually appropriate a share of the family home equivalent in value to the nil rate sum to the trust. So the trust would be of a share of the family home rather than the sum. And then the trustees would simply permit the surviving spouse to occupy it. Now, the common theme throughout each of these three schemes is that what the trustees are doing is they are reducing the value of the surviving spouse's estate, either by burdening that estate with a debt or by actually taking assets out of the surviving spouse's estate. So the idea then is that when the surviving spouse dies, their personal representatives will actually have to pay sums back over to the trust, either through in discharging the loan or by recognizing that part of the family home never formed part of the surviving spouse's estate. So whichever way you do it, you're reducing the value of the surviving spouse's net estate. And that means that there is less inheritance tax to pay. And the outcome should roughly be the equivalent as it is now, where the first spouse can simply leave their nil rate band allowance to the surviving spouse. Because with this scheme, you're reducing the value of the surviving spouse's estate by a sum equivalent to the nil rate band. So that's roughly speaking how they work. Now, as I mentioned, since 2007, it's been possible for the first spouse to transfer their unused nil rate band allowance to their surviving spouse. And since that date, it's generally been the case that clients should not use nil rate bands discretionary trust, that they're simply not needed anymore. So where you have clients who are still alive with pre-2007 wills, the normal practice is for them to update their wills and to get rid of the discretionary trust. What do you do when you're dealing with an estate which has a nil rate band discretionary trust in it? So that is so where the person has died and it's too late for them to update their will. Well, if the person died within 2 years, so if you're within 2 years of that person's death, the easiest way to unwind the nil rate band discretionary trust is to appoint the nil rate sum to the surviving spouse. And the reason you do that is that because it's within 2 years, that appointment should be read back into the first spouse's will. So it will be treated as though the first spouse simply gave their entire estate to their surviving spouse. That is the effect of Section 144 of the Inheritance Tax Act. And of course, if the first spouse leaves their entire estate to the surviving spouse, then they won't use any of their nil rate band. So therefore, they can then transfer that nil rate band to the surviving spouse on their respective death. What happens though if the person whose estate you're dealing with died more than 2 years ago? Well, what you absolutely must not do is you must not appoint the nil rate sum to the surviving spouse. That appointment will not be read back into the will, so it won't be treated as being affected by the first spouse's will. Rather, it will simply be treated as a disposition from the trust by the trustees. As I said earlier, the way the nil rate band discretionary trust works, it's by reducing the value of the surviving spouse's estate, either with a liability or by taking assets out of their estate. If, however, the trustees appoint everything in the trust back to the surviving spouse, then you wouldn't do that. You increase the value of the surviving spouse's net estate. So you lose all of the IHT savings. So you should not appoint anything to the surviving spouse if you're over the 2-year limit. So what you need to do in that scenario is simply constitute the nil rate band discretionary trust in one of the ways I mentioned before, through a loan scheme, a charge scheme, or by appropriating a share of the family home. And if you do that, then the nil rate band discretionary trust will work in the normal way, in the way these things worked pre-2007. It will reduce the value of the surviving spouse's estate. So you will achieve the IHT saving in that way. Despite the fact that for most clients, they should not be using nil rate band discretionary trusts now, there are certain circumstances where they actually might want to consider making use of these discretionary trusts. And broadly speaking, that arises in cases where if the first spouse were to give their entire estate to the surviving spouse, then that would lead to a loss of some inheritance tax exemption. So there are a couple of contexts where that might happen, and I've just got 2 examples here. One is to do in a case where there has been a prior marriage, and the other is to do with a case where there is a long-term plan to use discretionary trusts. So let's look at the first example where there's a prior spouse. So as before, we've got our first spouse who's going to leave their estate to their surviving spouse, but there is also a prior spouse. So the first spouse had entered into an earlier marriage with the prior spouse, and that prior spouse predeceased the first spouse. And when that prior spouse died, what that meant is that the first spouse in our example effectively gets 2 nil rate band allowances. They get their prior spouse's nil rate band allowance and their own. Now, when the first spouse dies, they can only pass one of those nil rate bands to their surviving spouse. So they're going to lose one of their nil rate band allowances. So what the first spouse might consider doing in this scenario is to, again, establish a discretionary trust of the nil rate sum and then pass the residue to their surviving spouse. So that's an example where a client might actually want to use a nil rate band discretionary trust to preserve one of their allowances. A second example of where you might want to use a nil rate band discretionary trust is where there is a long-term plan to use discretionary trusts. So let's say that our first spouse and our surviving spouse have agreed that on the second of their deaths, so on the surviving spouse's death, they're going to establish a discretionary trust. And that discretionary trust is going to exist for the foreseeable future. It might be, for instance, that they want to set up a trust for their grandchildren or remoter issue. Now, what might happen is that, well, let's say that in our example, the first spouse's net estate is worth £325,000. And that estate is then left to the surviving spouse on the first spouse's death. And let's say, conveniently for our purposes, the surviving spouse's estate is also worth £325,000. So the surviving spouse's estate on their death is worth £650,000. And we'll ignore, just for the time being, the residence nil rate band. So the surviving spouse, on their death, they set up a discretionary trust for their grandchildren and remoter issue for the sum of £650,000. Now that sum is precisely within the combined nil rate band allowance. So that means that on the surviving spouse's death, there will be no inheritance tax to pay. The problem will arise in 10 years' time when the first relevant property charge will arise upon this discretionary trust, because a settlement will only have a single nil rate band allowance. Effectively, this discretionary trust here only has the surviving spouse's nil rate band allowance. So the first £325,000 in the discretionary trust won't be taxed, but the remainder of the trust will be taxed at the under the relevant property regime. So it'll be taxed at a rate between 4 and 6%. And that will be an ongoing issue for the life of the discretionary trust. So what the parties could have done in this scenario is that on the first spouse's death, the first spouse could themselves have established a discretionary trust using their nil rate band allowance. And then the surviving spouse could themselves have established a discretionary trust for the same discretionary beneficiaries, if they like. And from the discretionary beneficiaries' perspective, the situation is largely the same. But the difference, legally speaking, is that there are two separate settlements. So they each have their own nil rate band allowance. So that will avoid or at least mitigate relevant property charges in the future. That's not the only way to do this. The other way, perhaps, of doing this is through establishing pilot trusts. Okay, so those are two examples of when you might want to use a nil rate band discretionary trust. Next, I'm going to talk about index-linked loans and the issues that arise from these. When nil rate band discretionary trusts are established, it's a common practice for the loan or the charge to be index-linked. The idea here is that when the surviving spouse enters into a loan with the trustees or accepts property subject to a charge, that loan or the charge will be linked to an index, often the retail price index. And that will mean that the loan or the charge will increase in value over time, provided that the index continues to increase. And the reason why this is common practice, it's really to protect the trust from the effects of inflation. The value of the trust won't be stagnant, it will increase over time in line with inflation. But Entering into these index-linked schemes also has a beneficial IHT saving, because what it means is that the amount which is owed by the surviving spouse to the trustees, so the debt that they owe to the trust, or the amount of the charge which the property is burdened by, will increase over time, and it will mean that the value of their net estate will therefore decrease over time. So by the time of their death, their net estate will be reduced by that amount. And that will then mean that there will be less inheritance tax to pay. I should say that that our thinking about this might be changed in light of current circumstances if the indexes have gone down, of course. But assuming that, you know, if these trusts have been in existence for 20 years, there will be most likely a net increase. So it leads to an inheritance tax saving. The problem, though, is that there is a sting in the tail. When the surviving spouse dies and their personal representatives have to pay back a sum to the trustees of the discretionary trust, they're paying not just the nil rate sum back to the trustees, but they're also paying back this additional amount, this index-linked element. So there's a question: how do you conceptualize that index-linked element of the sum that's being repaid? Is it interest for the loan, or is it a capital receipt? And the reason that's an important question is that the tax consequences are radically different. If you are to conceptualize the index-linked element of the loan as being interest, then that means that it's subject to income tax in the hands of the trustees, and they will have to pay income tax at a rate of 45%. Whereas if this additional amount that's being repaid to the trust is a capital receipt, then it's treated simply as part of the discretionary trust's capital. So the relevant taxation regime is inheritance tax, which means that you'll pay inheritance tax at a much lower rate, you know, between 4 or 5% every 10 years, although the effective rate is likely to be much lower. So it makes a large difference whether we conceptualize the index-linked element as interest or as a capital receipt. My view is that the index-linked element is a capital receipt. Interest is really compensation for being excluded from your money. And I don't think that that's how you should think about the index-linked element of a loan, because this is not a commercial transaction. Rather, the purpose of index linking these loans, as I said before, is to protect the trust from the effects of inflation. And that's a classic example of a capital receipt. Despite that, the Revenue have published their views on the matter in their Trusts and States newsletter in 2017, and they have said that the index-linked element of the loan will be treated as interest, and they have started to issue closure notices in such cases. So let's just think about the consequences of that. So there's two scenarios I want to talk you through. So the first scenario, we have the surviving spouse, and the column to their right represents their estate at the time of their death. And let's say the gross value of their estate is £1 million. However, they have a liability to the trustees of a nil rate band discretionary trust of £250,000. So that reduces their net estate to £750,000. Now, of that £750,000, the first £675,000 will be inheritance tax free, because that falls within their combined residence nil rate band and their nil rate band allowance. So the first £670,000 is taxed at a rate of 0%. That just leaves the remaining £75,000. That £75,000 is their chargeable estate, and that's charged at a rate of 40%. So the IHT due on the surviving spouse's estate is £30,000. Now, let's say that this liability to the trustees of the discretionary trust is index linked. And let's say that it has increased over time by £75,000. So the debt is now worth £325,000. The effect of that is that it takes the surviving spouse's estate out of inheritance tax, because the liability is increased such that the net estate is now reduced to £675,000. So there is no inheritance tax to pay. The problem, though, is that this £75,000 has now been paid to the trustees of the discretionary trust, and it's treated by the revenue as interest in their hands. So therefore, they have to pay income tax at 45%, which means that the tax due is £33,750, which is slightly more than the IHT due if the loan was not index linked. What I would say about this scenario is that I don't think it looks as bad. In practice, it probably won't be as bad as that. The reason being is that the rate of income tax is likely to be much lower than 45%, and indeed much lower than 40%. In part, that's because the trustees of the nil rate band discretionary trust will be able to set their costs, their expenses against that interest, which will reduce the rate. But more importantly, if that sum is appointed by the trustees to beneficiaries who pay income tax at anything but the highest rate, the additional rate of income tax, then the rate of income tax will fall. So if the best case scenario is that you can pay that sum of money between a number of discretionary beneficiaries who have an unused personal allowance or who pay income tax at the basic rate of 20%. So that will cause the rate of income tax to drop accordingly to hopefully a rate much below 45 and indeed 40%. Let's look at the second scenario, which is slightly more problematic. So in this scenario, let's say that the gross value of the surviving spouse's estate is £925,000. And let's say, again, there is a liability to the trustees of the discretionary trust of £250,000. That means that the surviving spouse's estate, the net estate, is worth £675,000. Now, combining the surviving spouse's residence nil rate band and their general nil rate band, that means that their estate is outside of inheritance tax, that their net estate falls entirely within the exemption. But let's say that, again, this liability is index linked. So what's happened is that over time, the liability has increased by £75,000. The problem now is that this sum of money, which now should be paid to the trustees of the discretionary trust, it's now being taken out of the inheritance tax regime, where, as we saw, it was subject to a rate of 0%, and has now been dragged into the income tax regime because it's now being paid as interest, according to the revenue, to the trustees. And because it's now being paid as interest, it's now subject to income tax at 45%. So instead of taxing this at 0%, it's now being taxed at a rate of 45%. So what can the trustees do in this scenario? Well, I think the best thing to consider doing is for the trustees to waive their entitlement to the index-linked element of the debt, effectively disclaim their entitlement to this £75,000. Because if they do that, it will not be treated as a liability of the surviving spouse's estate. So it'll go back into the surviving spouse's estate, but that's okay because it's there taxed at a rate of 0%. And it should not therefore be treated as income of the trustees, where it would be within the income tax regime. I think the issue to consider when doing this, though, is to consider trust law issues, because what the trustees are doing in this scenario is disclaiming trust assets. Now, in most cases, it will be a matter of swings and roundabouts. The beneficiaries of the discretionary trust will be the same beneficiaries as the beneficiaries of the surviving spouse's estate. So it makes no difference to them whether they get it through the discretionary trust or through the surviving spouse's estate. The difference, of course, though, is the tax regime through which it would pass. But if the beneficiaries of the discretionary trust are not the same beneficiaries as the surviving spouse's estate, the trustees should approach this with care, because they might find themselves being accused of being in breach of trust. I think the practical advice is to get all of the beneficiaries' consent if possible, and if you're worried, then to think about getting indemnities as well. Okay, the next topic is how does the nil rate band discretionary trust interact with the residence nil rate band? So the surviving spouse in our example will have their own residence nil rate band allowance of £150,000, and their surviving spouse, sorry, the first spouse to die will probably have been able to pass their residence nil rate band allowance to them. So there will be a brought forward allowance there. So the combined residence nil rate band allowance of our surviving spouse will be £350,000. The problem with the residence nil rate band, though, is that it's limited by the value of your home, or specifically the value of your equity in your home. So if the surviving spouse's equity in their family home is only worth if the value of the surviving spouse's share of the home is only worth £200,000, then that means that they will lose part of their residence nil rate band allowance. And that's a problem for cases where there's a nil rate band discretionary trust, because as we've seen, two of the ways in which these schemes are implemented, so the charge scheme or the appropriation of a share scheme, what they do is they burden the family home with a charge, or they simply take part of the family home out of the surviving spouse's estate. So it reduces the surviving spouse's equity in their home. And what that might do is it might prevent the surviving spouse's estate from utilising their entire residence nil rate band. So let's just look at how that works. So we have the surviving spouse, and their estate is represented by this column to the right. And the gross value of their estate is £900,000. And their estate is made up in part of their family home. And let's say that the market value of their family home is £450,000 at the time of the surviving spouse's death. So the remaining part of the surviving spouse's estate, sort of their general estate, is made up of, let's say, bank money, shares, and other investments, and that's also worth £450,000. But let's also say that there is a nil rate band discretionary trust, which is being constituted by a charge or by appropriating a share of this family home. So what that has done is that the charge on the home is worth £250,000. So this here is the liability to the trustees of the discretionary trust, but its effect has been to reduce the surviving spouse's equity to a mere £200,000. That is the surviving spouse's equity in the family home. And what that does is it sets an upper limit for the amount of the residence nil rate band which can be claimed. So the surviving spouse's estate can only claim £200,000 of their exemption. So they're effectively losing £150,000 of their residence nil rate band. That then leaves their remaining estate, which, as we said, is worth £450,000. And what the surviving spouse has to do is, or their estate has to do, they can't apply the remaining £150,000 of the residence nil rate band to that general estate. Rather, they can only apply the general nil rate band to that estate. So that means that the first £325,000 of the remaining estate is taxed at 0%, but the remaining £125,000 of value is taxed at 40%. So there's going to be IHT charged of £50,000. Now, what can the surviving spouse do while they're still alive to prevent this happening? Well, one possibility to consider is, first thing to say is that this liability here to the trustees of the discretionary trust, we want to preserve that liability. Because as we've said, that's how the discretionary trust scheme works. It's by burdening the surviving spouse's estate with a liability. And that reduces the value of the surviving spouse's estate, taking more of it out of the IHT regime. So we do want to preserve this liability, but what we also want to do is we want to prize it away from the family home. We want to effectively move this liability from the family home to down here as being part of the surviving spouse's general estate. So one possibility is for the surviving spouse to reach an agreement with the trustees of the discretionary trust, whereby they would swap this charge over the family home, or indeed if the trust has been constituted by appropriating a share, effectively buy back this share of the family home, and in return give an unsecured loan. So essentially promise to repay this sum of £250,000. You're effectively swapping a charge for an unsecured debt. You're transferring the charge to a loan scheme. So let's look at how that would work. So the surviving spouse, again, their family home is worth £450,000 and their general estate is worth £450,000. They've agreed to purchase back part of their family home, or have paid or have asked the trustees to release their charge upon the family home. So they now have the entire equity in the family home. But what's happened is the liability has now been transferred to their general estate. And what that then means is that they are now free to claim the entire residence nil rate band on the surviving spouse's death. So by swapping a charge for an unsecured loan, you free up the surviving spouse's estate to claim the entire residence enhancement. And if we look at how the IHT calculations pan out now, again, we say that the gross value of the estate is £900,000. It's reduced by the liability to the nil rate band discretionary trust by £250,000. So the net estate, subject to IHT, is worth £650,000. You claim the full residence nil rate band of £350,000, and then you can claim, well, you don't need to claim the entire nil rate band, you just can claim the remaining £300,000 as part of your nil rate band allowance, and that takes the estate entirely out of the IHT regime. So that's one way of thinking about how to sort of mitigate the effects of the discretionary trust so far as it interacts with the residence nil rate band, whilst keeping the scheme in place. If you are going to go down this route, I think there are a number of factors to consider, and I think this type of planning should be approached with care. So matters to consider is, well, is there going to be an SDLT charge? I think that depends upon the type of scheme that's been adopted. There probably will be an SDLT charge if the scheme has been constituted by appropriating a share of the family home to the discretionary trust. Although that SDLT charge is probably going to be less than the IHT savings that you might reduce, as in our example. You'll also need to review the CGT position. So if there is a sale of the share of the home, or if you're discharging a charge upon the home, is that going to give rise to any CGT liability? Again, I think that's something that you'd need to consider in light of the type of scheme that's being used. I think the answer to that will depend upon whether it's been affected by a charge scheme or by appropriating a share to the value of the home. And then you'd need to think about whether that you can claim principal person's private residence relief. Also be wary of falling into the Fazakali trap. Fazakali was a case back in the noughties. I think it's 2004, Fazakali. And what had happened there is that the person who, in our example, would be the surviving spouse, had, during their lives, gifted a large part of their family home to the first spouse, and then they'd effectively bought back a share of the home through entering into the loan scheme. And when you're buying back a share of your home, a share that you'd gifted away, then you fall, or you potentially fall, within the reservation of benefit rules, which will undo all of your IHT planning. So you'd need to make sure that you're not going to fall within the Fazakali trap. And finally, consider trust law issues as well. Because in the scheme that I've just suggested, what the trustees are doing in this example is that they are giving up a share of the family home, or they're giving up a charge on the family home for an unsecured debt. That they're effectively swapping a secured debt for an unsecured debt. And you might say, well, they're putting sort of the trust fund into jeopardy by doing that. So query whether or not they're going to be liable to any claims by disgruntled beneficiaries. Again, in most cases, that won't be the case, because the beneficiaries of the discretionary trust will also be the beneficiaries of the surviving spouse's estate. So it won't really matter whether they get the assets through the trust or through the surviving spouse's estate. It will just lead to an IHT saving. But where that's not the case, or if there's discord in the family, consider whether or not this kind of step will raise potential liabilities. And then, wonder whether or not you should try to get disclaimers from beneficiaries and indemnities and so on. Okay, so that is all I have to say about how you might think about using the residence nil rate band, mitigating the effects of these discretionary trusts on the residence nil rate band. And that's all I have to say about the topic and the disclaimer again. Okay, so I think a few questions have come through, and I will try my best to answer them. Okay, so the first question, so on slide 7, the double nil rate band discretionary trust will also mean that any exits in the first 10 year would also create a charge. Is that right? So so this was our example of where there is a prior spouse, and as we said, that means that the first spouse will have 2 nil rate band discretionary trusts. And what I suggested is that the first spouse, they'd set up a nil rate band discretionary trust on their death, and then pass the residue of their estate to their surviving spouse. Yeah, so the nil rate band discretionary trust that was set up on the first spouse's death will then be subject to the relevant property regime. And yes, there is a question then of whether it will give rise to an IHT charge in 10 years' time. I'd have to think about that. I don't know the answer off the top of my head. I'd have to look at how the IHT regime works. I think that there might be a practical answer to it, which is that these discretionary trusts are typically thought to be holding trusts. So the idea is that you would bring it to an end before you reach that 10-year charge. So, and of course, if it gets out of the trust before the 10-year charge, there won't be any charge. But I'd have to think about what happens if you leave it in the 10-year charge. Yes, so the second question, could the waiver by the trustees of any indexed amount bring about an IHT exit charge in the trust? You're all asking very difficult questions here. And again, I'd probably have to think about that. I think the answer is yes, it probably could, because omission to exercise a right is a transfer of value under the IHT regime. And if that tips you over into if that sort of takes you over the exemptions, then yes, that could trigger an exit charge. But again, if you're within the 10-year period, I don't think that would be a problem. So thank you, Gavin, for that question. So the next question, can a nil rate band discretionary trust still be useful where you have spouses who both have children from previous marriages? They both want to provide for the survivor during their lifetime, and on the second death, they both want to ensure that the nil rate band goes to their respective children. I think the short answer to that is yes, certainly. I'd kept it as quite a simple example there of where there is only one prior marriage, but it applies equally where both of the spouses have prior marriages, because they'll both then have double nil rate bands. So they should both consider having discretionary trusts within their wills. I think a very helpful book on this is James Kessler's book about establishing has a good chapter on nil rate band discretionary trusts, and he goes through all of the different permutations of multiple marriages. Okay, the next question, a question disclaiming the index element. Consent of all discretionary beneficiaries obviously cannot be obtained where the class of beneficiaries has not closed. Is this likely, therefore, to still cause the trustees issues for being in breach of trust? Yes, certainly. So if the discretionary trust is established for remote beneficiaries, they will often be unborn or minors and cannot consent. So that's why I think the trustees just need to give some consideration to it. Often they'll be satisfied by getting the consent of the beneficiaries who have reached majority, but if you're worried, then you should then consider getting indemnities as well. Can the trustees exercise the debt and charge scheme without specific powers in the will, i.e. under the step provisions? I don't know the answer to that. I think I'd need to look at the step provisions. I think a lot of these schemes are drafted, again, I think Kessler's scheme is drafted so that the trustees have the power to disclaim the debt without incurring liability. So if they've got that express power, then yes, they can disclaim the debt. And that, of course, includes the indexed linked element without being in breach of trust. But if there is nothing on that within the trust or within the step provisions, then technically they will be in breach of trust and should be thinking then about getting indemnities. Next question, what should be done if property held as tenants in common, but nothing done on death of first spouse to carry out the nil rate band discretionary trust in the will, and the grant of probate not obtained as the surviving spouse believes she inherited it all? So that's a really good question, and I've had to deal with a couple of cases like this in practice. So that's effectively where nothing has been done to constitute the nil rate band discretionary trust. So on the first spouse's death, everything has just been paid over to the surviving spouse. I think that the nil rate band discretionary trust scheme still works there, but it works in a slightly roundabout way. Because if you think about it, the discretionary beneficiaries of the trust, they have an equitable interest in a nil rate sum. Or specifically, they have an equitable interest in the first spouse's estate, in assets in the first spouse's estate, in order to satisfy the nil rate sum. And what's happened is those assets have just moved then into the estate of the surviving spouse. And I think the best way to think about it then is that they would have, as a matter of trust law, a tracing claim, so they could follow those assets into the surviving spouse's estate. So again, it's a simple liability of the surviving spouse's estate. So I think, so it hasn't been done in a neat way that you could to show to the revenue, but I think the trust law principles are still there. There is still a liability of the surviving spouse's estate, which will reduce the value of their net estate on their death, taking some of their estate out of the IHT regime. But what you won't have is you won't have all of sort of the index-linked elements of the loan, because none of that has been put into place. It's just a simple, straightforward tracing claim that that would lead to a liability of the surviving spouse's estate. Okay, so we are using, so the next question, we are using nil rate band discretionary trust for spouses, where the total estate is over £2 million, and we're taking the nil rate band outside of the survivor's estate, takes the estate closer to £2 million. taper threshold to preserve some or all of the surviving spouse's nil rate band discretionary trust. Is this worth doing in your opinion? So I think I'd need to think through that. So you're of course, so with the residence nil rate band, once your estate is over £2 million, the amount of allowance you can claim starts to taper off. I think I don't think I could answer that straight away. I think I'd really need to think through how that would work. So forgive me. What I'll try to do is to provide a typed answer after this seminar is finished to that question. Okay, the next question. Are there any disadvantages to using a nil rate band discretionary trust as opposed to relying upon the transferable nil rate band? Why I advise is revising wills to rely upon the latter. So effectively, if you've got a client with a nil rate band discretionary trust, why not just leave it in place? Is there any advantage to using the transferable nil rate band? I think there probably are, because I think what we've seen today is this nil rate band discretionary trusts give rise to all sorts of unexpected sort of tax and trust law issues. I mean, the thing that I mentioned at the end there, the Fazakali trap, is a common one, which can arise where you're implementing a nil rate band through a loan scheme. That there's a risk that you'd fall into the reservation of benefit rules. The other problems that sometimes arise is that the revenue can take quite a funny view of some of these schemes. So that they have taken a view that where a nil rate band discretionary trust has been implemented through appropriating a share of the family home to the trust, they sometimes say that gives the surviving spouse an interest in possession in the home. And if you do that within 2 years of the first spouse's death, it sort of unwinds the nil rate band discretionary trust. So I think because of sort of the finicky trust and tax issues, I think it's a good idea to get rid of these things unless there's a positive reason for keeping them. The second question, the next question, what's the best way of constituting a nil rate band discretionary trust where the deceased has died over 2 years ago? I think the answer to that question relates to the answer I gave to an earlier question. I think it really depends upon whether or not the first spouse's estate has been administered yet. So whether or not all of the assets have been assented to the surviving spouse. If they have done that, then I suppose there's only one thing that you can do, which is you can enter into a loan scheme with the surviving spouse. It's too late to charge property or to appropriate a share of the property. I think where you no longer have those, where the trustees no longer have those assets. I think that's right. I say that in a caveated way. I'd probably need to think about that. But yeah, I think the only thing you could do would be to enter into a loan scheme with them. So sorry, my children are making a racket. You could probably only enter the loan scheme, and if you were to do that, again, be wary of the Fazakali trap I mentioned before. The other option is to do nothing, and then you can, as I mentioned earlier, the trust still works, but it operates as sort of a general trust law liability on the surviving spouse's estate. Okay, the next question, is the nil rate band trust still useful in a case where the first spouse has now died and they had a prior spouse, sorry, I've lost the ability to speak, and they had a prior spouse who died in 1968 before the rules in 1973. I don't know the answer to that question. I'll have to get back to you on that one, I'm afraid. The next question, if 10 years pass between spouses' deaths and the index-linked element charged on the property has taken the first spouse's nil rate band discretionary trust above the nil rate band, will an IHT 10-year charge apply on assets for which there are no liquid assets to pay for it? I think the answer to that is yes. I mean, it really depends upon the market value of the assets in the trust. I think if you've got a debt worth £325,000 and it's sort of increased in value, say to £350,000, I think perhaps the market value of that debt will be £350,000, which takes you over the IHT threshold, for which there'll be an IHT charge. I think I'd probably need to check that, but I think that's what would happen. So there would be a charge, but it would only be upon the excess, upon the amount above the nil rate sum. So the rate of IHT will be very low. Okay. The next question, is there a loss of PPR for CGT if the trustees of the nil rate band discretionary trust, which includes a share of the family home, had not recorded the right to live in the property so that for the survivor by trustees memorandum, and the property is now to be sold by the survivor? I'm not sure there's a straightforward answer to that. PPR, when you have a trust, is quite generous as a result of a case called Sampson and PE. And what Sampson and PE says is that even where you've got a discretionary trust and you allow a beneficiary to occupy the property, they're still entitled to occupy it under the terms of the trust, which allows them to claim PPR. And I think that would apply to the surviving spouse. The problem, though, is simply proving that to the revenue. Proving that they had a right to occupy, the trustees had to allow them to occupy it. And a memorandum would be incredibly helpful in that scenario. But just two points to note there. For one, I don't think as a matter of trust law, you do need a memorandum unless the trust says that you can't exercise this power to permit a beneficiary to occupy, unless there's some kind of document. There isn't a general trust law requirement to exercise those powers in writing. But again, it's simply a matter of proof for the revenue. And the other thing just to note, be wary of exercising that power within 2 years of the first spouse's death. Because if within 2 years of the first spouse's death, you appoint a right to occupy to the surviving spouse, that will be read back into the will. So it will just be seen as an outright transfer of that share of the home to the surviving spouse, which is not problematic because then you'll just have the full transferable nil rate band. But if you're trying to keep the nil rate band discretionary trust alive, you should be wary about making any appointment to the surviving spouse, any right to occupy, until that 2-year period has expired. The next question, are you referring to Drafting Trusts and Wills by Kessler? Yes, I am. An excellent book. The next question, as there is no transferable nil rate band from the prior spouse, then there are 2 entitlements to benefit from now. As there is no transferable nil rate band from the prior spouse, there aren't 2 entitlements to benefit from now. I'm not sure I understand that question. Perhaps if Simon could send me an email with that question. I'm not sure I follow it. I'm sorry about that. I'll try my best if you send the question again. And the final question, where all of the assets of the estate have been transferred to the surviving spouse in ignorance of the trust, and there is a power to apply capital for beneficiaries, do you consider this to be an unwinding in accordance with section 144? Well, that's a really difficult question. If the trustees have paid everything over to the surviving spouse, what you might then say is, well, look, what they've done is they've exercised their power of appointment and appointed all of the assets to the surviving spouse. I think the difficulty that you'll have in demonstrating that to the revenue is that when trustees or personal representatives in this scenario, when they make appointment, if they want to exercise the power of appointment, then as a matter of general trust law, they should attend their mind to that specific power and intend to exercise that specific power. So that's why, you know, the standard practice is to have a deed where you would say in your recital, the trustees have this power of appointment and they intend to exercise this power of appointment by appointing the assets to the surviving spouse. If they haven't done that, if they've just paid over the estate to the surviving spouse, ignorant of the fact that they've got this power, then I don't think as a matter of general trust law, they have exercised that power. And I think that the revenue might therefore take an issue with it. So I think that's why it might be problematic. It's good practice then, of course, to have a deed where you expressly state that you are exercising that power. Okay, those are all of the questions I received. So thank you very much for the great questions. And it's a pleasure to speak to you today. And I hope that all you and your family are well. So thank you.